Hello everyone! Today we continue with our topic on open economy. In the beginning of this week, we have covered the first half of this lecture. We have learned what international trade flows are, what are exports and imports. Then we moved on to the balance of payments concepts. We have learned what are the components of balance of payments, what is the balance of payments identity, how can we write it down, how deficits and surpluses occur within our international trade. And today we'll focus on the second part of this lecture, which is covering exchange rates. We will mainly focus on exchange rate fluctuations, different types of these fluctuations. And at the very end, we will cover a few different alternative exchange rate regimes, which different countries can adopt. First of all, let's define what exchange rates are. An exchange rate is simply the rate at which one currency can be exchanged for another on the foreign exchange market or forex market. So strictly speaking, it's simply a price of one currency in terms of another currency. For example, £1 can be equivalent to $1.50 or 1.1 euros. A particular currency frequently can rise against some currencies but fall against others. For example, our pound can become stronger against American dollar but weaker against Swiss franc. And that is why, in order to get a general picture of exchange rate fluctuations of a particular currency, an exchange rate index, which is a weighted average of exchange rates of main trading partners, can be calculated. Why do we need to study exchange rates within this topic? This is because exchange rates will affect countries' trade flows. They will affect attractiveness of our exports to foreigners, and it will also determine how cheap or expensive imports are for our own citizens. And as a result, it will determine the direction of these flows, it will determine the volumes of exports and imports, and therefore it will determine the country's balance of payments. Let's have a look at an example of how exchange rate index can be constructed. First of all, we'll need to write down a list of countries which are our main trading partners. And then we can assign the weights of their currencies within the exchange rate index based on the volume of our trade with them. For example, as our main trading partner are European countries, approximately 46% of our trade is with them, their currency will carry the highest possible weight within the index. Our second most important trading partner is America. Approximately 17.5% of our trade is with Americans, so that is why we assign the same weight for American dollar within the exchange rate index, and so on. The sum of these weights will be equal to 100, and then we simply take the actual exchange rate of a particular currency, multiply it by its weight, and this will give us the total value of our exchange rate index. The actual number itself doesn't really mean anything. It can be 20, it can be 200, it can be 2 million, or whatever number. It doesn't really matter. What matters is the fluctuations, is the changes in this exchange rate index, whether it goes up or down. Let's have a look at the changes in the value of pound against our major trading partners. For example, if we have a look at the value against Japanese yen, which is shown by this orange number, we will see that pound is constantly loses its value. Our vertical axis measures amount of foreign currency units per 1 pound, and if this line is downward sloping, it implies that over years we will be able to receive less and less of this particular currency. Less and less yens will be exchanged for 1 pound. 1 pound can buy less and less yens. It becomes cheaper relative to Japanese yen. If we look at American dollar, we can see that it roughly approximately holds its value over the long term. Sometimes pound appreciates, sometimes dollar become more expensive, but generally we do not lose value against the dollar. And our index overall, shown by this red line, shows, however, that pound does become cheaper, so the trend is downward sloping. In other words, you can have a look at this exchange rate index shown along another vertical axis. Pound loses value against other currency of our major trading partners. Next, let's discuss the determinants of exchange rates. In other words, what factors which will affect the exchange rate of a particular currency. This will be especially interesting for people who plan to become a trader in forex markets, who plan to benefit from fluctuations in the exchange rates. You definitely need to know this. So generally, the basic idea is very simple. Exchange rates are determined by the demand and supply of currencies in forex markets. So let's draw a very simple graph. Have a look. We can analyze exchange rates within the same demand and supply diagram which we have covered in the very beginning of this module. So let's analyze two markets. Market for pounds, for example, for British pounds, and let's say market for American dollars, another currency, and we will analyze the exchange rate of pound against the dollar. As always, we'll have quantity along horizontal axis, and in this case it will be quantity of pounds traded in the forex market, and here in this graph we'll have quantity of dollars traded in forex market. Along the vertical axis we'll have price as normal, as always. In the first graph it will be price of a pound, and in the second graph it will be price of a dollar. Everything as normal, and the same demand and supply diagrams, the same demand and supply curves will still apply. So we will have downward sloping demand for each currency for pounds and dollars, and upward sloping supply, right? And interaction between demand and supply will determine equilibrium values of each of these currencies. This will determine equilibrium volume of a particular currency traded in the foreign exchange market, and equilibrium value of a currency. In other words, an exchange rate of a pound and exchange rate of a dollar. They will be equal to some number. For example, in our starting position could be that 1 pound is equal to $1.3, right? That's the starting point. And now let's have a look what factors can shift the exchange rates. And as you can guess from the diagram, changes in the exchange rate will come from changes in demand and supply for these particular currencies. And the first factor which will affect demand and supply for currencies would be changes in the demand for imports and exports. In other words, our trade flows. Let's have a look at the graph. Let's imagine that we, British citizens, want to buy more of American products. For example, let's imagine that demand for Teslas, which are American cars, goes up. Demand for Tesla increases. We want to buy Tesla cars, and we also want to buy Tesla stocks, Tesla shares, because they have appreciated recently, they've demonstrated significant growth, and we want to invest in this particular company. So demand for Tesla products goes up. We want to buy lots of Teslas, and in order to do this, we'll need to pay for our purchases in American dollars. So in other words, the demand for American dollars will increase. New demand for dollars in forex markets. We will need to exchange our pounds into dollars. And as you can see here, when demand for dollars goes up, our equilibrium will move to a new point, which will push the exchange value of a dollar up. Dollar becomes more expensive. This currency is more in demand, it's highly valued by investors and by people who want to buy American products, and that is why the value of this currency increases. Dollar appreciates. At the same time, British pound will lose its value. This is because we will need to exchange our pounds into dollars, and to do so we'll need to sell our pounds. We are offering our pounds into the forex market, so supply of pounds will increase. We want to get rid of our pounds, we want to exchange them into dollars, and as a result equilibrium in the market for pounds will also change, which will lead to a pressure on the exchange rate. There will be a high amount of pounds sold in the market, and as a result of this, because the huge number of pounds floods the market, exchange rate of a pound will drop. And as a result, eventually our new equilibrium will be a new value, let's say $1.2 per each pound rather than 1.3. Each pound will be able to buy less dollars because there is additional supply of pounds in the market and there is an additional demand for dollars. So this is how changes in the demand for exports and imports, in this case we have a stronger demand for imported products, will affect demand for various currencies, which will affect the exchange rates. As you can see here, the same idea which we have covered in the beginning of the module, the simple demand and supply diagram, can be applied to very many markets, and you can even benefit from this analysis, from this tool, for your own personal financial benefit. If you are able to forecast these exchange rate changes, and as you can see here, it's not actually difficult to do, you will be able to trade successfully in forex markets and earn significant profit. Next factor which will have an important effect on exchange rates is the difference between interest rates in different countries. When a country has a higher interest rates compared to another, it will lead to exchange rate of its currency appreciating. In other words, when interest rates are high, exchange rate will be high too. It's very easy to memorize, but the logic is quite simple. Let's discuss an example. Let's imagine that we trade with European Union and interest rates in our countries are different. In the UK, interest rates is low, for example 2%, while in European Union, in European countries, they are slightly higher, 5% rather than 2%. The question is, if you were an investor, where would you invest your money? International capital flows are quite hot. In other words, investors can easily move their capitals from one country to another. There are no restrictions to international capital flow in modern economy. You can easily buy shares of whatever company you want. So if you want to invest in European countries, you can easily purchase European shares. If you want to invest in British economy, you will buy shares of British companies. So the question is, if you have lots of money, where will you invest? What are interest rates? Interest rates give an idea of a normal rate of profit in financial markets. And in the UK, the normal profit rate would be 2%, while in European economy, it would be 5%. So where will you invest? Apparently, you will want to earn highest profit on your money, on your capital, and therefore you will prefer to withdraw your capital from British economy and to invest in Europe instead. This will lead to differences in demand for various currencies. Let's illustrate this on a graph. So as previously, I have drawn two graphs here. This is the market for pounds, demand and supply for pounds, original equilibrium, which determines the original exchange rate of the pound against European currency. For example, currently 1 pound can purchase 1.2 euros. And here on this diagram, we have a similar demand and supply for euros and equilibrium exchange rate of a euro. And now imagine that we introduce interest rate differential. In other words, interest rates will be different. So interest rate in the UK is low. Interest rate is 2%, while interest rate in Europe is 5%. This is Europe, this is UK. How this will affect the exchange rates? What will be the dynamics here? The logic is simple. Capital owners will want to move capital from the UK to Europe. Capital flows from the UK to Europe. This will affect demand and supply of various currencies. So as a result, because we want to get rid of British assets, this will increase supply of British pounds in forex markets, and apart from this, it will increase demand for European currencies because capital owners will want to get rid of their shares of British companies. They want to withdraw from British economy. They want to exchange the pounds which they have at the moment into euros. So supply of pounds will increase, new supply will be higher, and demand for euros will increase too, because they will want to purchase European stocks, European assets, because they will generate higher interest. So new demand for euros will be higher. And of course, our forex market will move to a new equilibrium point. In other words, exchange rate, the value of a pound will drop, while exchange rate or the value of the euro will go up. And eventually new exchange rate will be established, and for example 1 pound will now be able to purchase less, let's say 1.1 euros rather than 1.2 as previously. So these effects, these changes in the exchange rate were caused by interest rates differentials, and the logic here, as I mentioned, is lower interest rate will lead to the lower currency. Higher interest rate will lead to the higher value of the domestic currency. Thus, the main determinants of exchange rates, which we've covered, would include changes in demand for imports and exports, also relative interest rates in different countries, differences in interest rates, which will cause capital flight from one country into another. Apart from this, there will be some other determinants which will affect the values of different currencies. For example, differences in inflation rates in different countries, changes in income levels in different countries as well, relative investment opportunities. If a country creates a really good opportunity for foreign direct investment, it will attract capital from abroad. It will lead to higher demand for its domestic currency, which will put an upward pressure on its exchange rate. The currency will appreciate if everyone wants to invest in this economy. Also, speculative sentiments, global trading patterns, and similar factors will change the value of various currencies.